All right, we are officially starting with Koponik Business Forum for this year, and it is my great pleasure to moderate the first panel here. And a lot of thanks from my side to people who are already in the crowd. I know that's the first day, and people are still coming to Koponik, but it's great to see you guys here. And today we're going to talk about the Western Balkans outlook, and at the same time we'll talk about the challenges for growth in uncertain times. That's the topic of this panel. And uncertainty has become quite popular and quite a term that was in the spotlight since the global financial crisis, pretty much. And uncertainty as such is not really always bad for economists, for economy and for businesses, right? Because if it's there, it pushes you to be adaptable, to innovative, to resilient. And at the end of the day, for us as economists, as business people, we can always blame uncertainty for some missed KPIs. It's not me, it's not you, it's uncertainty. However, uncertainty, when it is elevated, it might become a key challenge for policymakers and for growth. And if we believe into Nicholas Bloom and his co-authors who compile regularly the measure of economic policy uncertainty, it has been at a quite high level at the moment, and in fact at the highest level apart from that period in April last year, at the highest level of the last 10 years. And given what happened yesterday, we'll have a probably additional spike in uncertainty until the markets consume what has happened. So against that backdrop, today we're going to focus on the Western Balkans outlook, having in mind certain times, and we're also going to, after that, dig a bit deeper into industrial policies, which is another theme that is going through today's forum. And it's my great pleasure to have such a great lineup today. With us, Sebastian Sosa, a regional representative for the Western Balkans for the IMF, Richard Record, lead country economist for the Western Balkans for the World Bank, Marko Voljc, senior advisor for Andersen, and Dimitar Bogojev, hopefully if he's joining online. Yeah, hi Dimitar. Can you hear us?
Yeah, hello,
awesome.
Hello, Professor Nedeljković. Yeah, I'm hearing you
very
well.
Dimitar is the lead regional economist for the Eastern Europe and Caucasus at the EBRD and former governor of the Central Bank of North Macedonia. So it's a great lineup. And without further ado, let's maybe focus on the Western Balkans outlook as the first part. And perhaps we can start with Richard giving us his view and maybe more on the structural, on the real side of the economy when we talk about the economic outlook.
Great, thanks very much, Milan, and always fun to be in Koponik. So, yeah, I guess if you were going to sort of do the short version of what does the regional outlook kind of look like at the moment, I guess we'd say sort of not bad, but not great. Clearly, we're seeing continued weak external demand. That's very closely driven by the sort of uncertainty that we've been talking about for the last year plus. That's obviously affecting trade and investment. That matters to the region, especially to the relatively more industrialized economies like Serbia. And perhaps those economies, although what's interesting is, when there's uncertainty, investors tend to sit on their hands, a lot less trade and investment flows, but everyone in Europe still goes on holiday. So the kind of tourism-driven economies, Albania and Montenegro, are not doing too badly, actually. Mm-hmm. So we're seeing a little bit of a sort of rebalancing across the region. I think what's also interesting is we're seeing continued reliance on domestic demand. That's increasingly driven by continued rapid wage growth and also credit growth. I think that's perhaps unsurprising, given that we've had this sort of series of demand stimulations since COVID, energy crisis, war, inflation, more inflation. But our worry is that it's not that sustainable, and essentially we're going to get to a position where we see sort of increasing external imbalances if we see that sort of continued growth. So maybe it's time to sort of start thinking less about demand side, demand stimulation, more towards supply side, supply stimulation. And that kind of goes back to what we're calling the sort of jobs challenge that the region increasingly has. This remarkable paradox in this part of the world where you can see sort of simultaneous relatively high rates of unemployment, yet every employer you talk to says they can't find people. So clearly things are not quite working in the labor market. We worry also that we are seeing wages everywhere in the Western Balkans rising faster than productivity. I think on average around sort of 3, 4, even 5% unit labor costs per year. At the moment, our estimate in Serbia, productivity at labor level is probably more like 2%. If that happens indefinitely, then we get to a point where we start seeing significantly eroded competitiveness. So, a big challenge, I think, particularly around is we want to see further reductions in unemployment, further increases in labor force participation. It's not just any job, it's the types of jobs, higher quality jobs, jobs that bring greater productivity that are the ones that are really important. And when you look at productivity growth, particularly in Serbia, you see the biggest drivers are new entrants coming into that's either new investors, particularly FDI, and competition between more productive and less productive firms, much less what we call within firm productivity growth. So certainly reduction in FDI, we worry about it from a macroeconomic and a capital financing perspective, but particularly from productivity, because it's, I think increasingly for Serbia, it's less the money, more the skills, technology, management practices, the kind of secret sauce that leads to more productive jobs and therefore better paid jobs. Thanks.
Thanks, Richard. Thanks for the overview. Dimitar, please, can you just share with us, EBRD is coming up or has already come up with a regional outlook. Perhaps you can share your insights from the report and your also personal views on the outlook for the Western Balkans.
Yeah, thank you, Milan. I would not like to repeat with what Richard said because our findings are more or less similar. And last Thursday we published our new regional economic prospects. In this issue, we looked a bit on the trade tensions that were quite acute last year, and maybe I will share a few findings from there. We made a deep dive into the shifting global trade patterns, and actually some of these are quite interesting also for the region and for Serbia itself. So the two largest economies, China and the US, reduced their bilateral trade flows, and that had impact on other economies. China, for example, China's export increased, total export, while the US substituted Chinese imports with goods from alternative markets. And when we look at the EBRD economies, they played quite a modest aggregate role in this shifting trade patterns, but in several product categories, like, for example, precious metals, computers, phones, chocolate, EBRD exporters actually gained significant US market share, so took some share from China, which reduced the export there. On the other hand, export from China to EBRD regions also increased, and this is driven by cost competitiveness, higher production capacity in China, but also, and this is very important, because of the global demand shifts, mainly linked to the AI, and China is exporting. It's good that EBRD regions are entering this area and actually import some products also. EBRD economies now export more diverse and more sophisticated product baskets compared to 2 decades ago. And emerging markets with strong Chinese FDI, they have benefited from faster export growth in product categories where China got to dominate most over the past 20 years. And this is probably also quite relevant for Serbia. Moving to the Western Balkan economic outlook, growth there slowed last year from 3.7% in 24 to 2.5% last year, and this is mainly due to the weaker than expected performance in Serbia. Growth projected to recover to 3.1% this year and 3.5% next year. And this will be driven by domestic demand, but also by major public investment and regional infrastructure projects. And when we move to Serbia, after 2 strong years, GDP growth slowed to probably around 2% in 25. And this was a broad-based moderation in activity. Construction and energy sectors contracted, while services and manufacturing especially of electric vehicles and tires continued to expand, and this partially cushioned the slowdown. The current account deficit remained broadly unchanged, but FDIs halved, and this signals quite weak investor sentiment and some capital outflows, and this is probably connected to the whole situation that was prevailing during the previous year. Inflation fell to 2.4% recently in January, and this was supported by temporary retail margin caps. However, we still see core inflation pressures persist, and this is an issue that we see that central bank is monitoring carefully, and they are quite prudent with their monetary policy. Fiscal developments, I would say, are relatively stable. Fiscal deficit widened, but remained within the 3% of GDP target, and public debt even declined slightly to 44.5% of GDP by December. What is the medium-term growth outlook for Serbia? We expect actually growth to rebound to 3% this year, and then this to accelerate to 3.8% next year. And this would be driven by recovering investment. Also, we expect that Expo 27 in Serbia will boost demand across several sectors, so all this will actually improve the growth prospects. But at the same time, we see some risks and vulnerabilities to our forecast. Energy supply vulnerabilities pose a significant risk to both economic stability and industrial activity. We hope that this energy uncertainty will be reduced significantly if all goes according to the development so far. Then social discontent continue to weigh on investor confidence and investment climate, and slower FDI inflows and persistent core inflation pressures could also limit the strength of the recovery. Let me stop here for the first round.
Thanks a lot, Dimitar. And you gave already a bit of a heads up for Sebastian. What I would like to hear from him is about policies and what can we expect in terms of the outlook with respect to main macroeconomic policies. Also, Richard mentioned some of the things about needs for structural changes, but maybe we can focus that in the second round. So maybe now we can focus on the monetary and fiscal policy.
Yeah, thank you very much, Milan, and thank you very much to the organizers for the invitation. It's always a great pleasure to be here at the Capone Business Forum. So on the short-term outlook, I basically agree with what Richard and Dimitar mentioned. In a nutshell, as Richard said, the short-term outlook doesn't look great, but it's not too bad. So we after some growth moderation last year, we expect a pickup in growth this year, partly due to the pickup that we expect here in Serbia. So on average, we expect growth at roughly 3.2%. And what is behind this acceleration? We continue to see domestic demand as the main driver, probably with some more moderate contribution from private consumption, as real wages sort of come down from the very high growth rate that we observed in previous years. And also supported by investment, particularly in some countries due to some large public investment infrastructure projects. In terms of inflation, we continue to see relatively elevated headline inflation in some countries. I don't know, for example, in North Macedonia, in Montenegro, in Bosnia. And in particular, we see services inflation quite sticky, and core inflation remains also elevated. And this in part reflects the real wage growth that we mentioned before, right? We have also seen a deterioration of the current account deficits across the region. In some countries, is quite significantly, I would say, and we expect this year to remain in some countries elevated as well. Something that I would like to mention about this baseline scenario, right, for the short term is that it's, of course, surrounded by significant risk, mostly coming from the external front. And here I would just mention, of course, the very high uncertainty related to potential risk coming from geopolitical areas, geofragmentation, economic fragmentation, and also uncertainty related to trade policies. So in terms of the medium-term outlook, we expect growth to converge to potential growth over the medium term, which is, continues to be limited by some significant structural gaps across the region. So definitely one of the key policy challenges remains, implementing an ambitious structural reform agenda that can unlock productivity and the growth potential of the region. Regarding short-term policies, and I would focus on these monetary, fiscal, and financial sector policies, in countries where inflation remains elevated, there is a need to maintain a relatively tight stance, right, until headline is firmly on a downward path, and we see core also coming down, and also inflation expectations converging to central bank targets. I think we also think it's important for policymakers, central banks, and supervisors to closely look financial stability risk. In general, the banking systems in the region have been doing quite well. Banks are generally liquid, well capitalized, profitable. There has been strong credit growth, actually in some sectors quite strong, particularly to households and real estate. So that's something that needs to be monitored really closely, and supervisors need to be ready to tighten macroprudential measures if needed. And of course, continue to closely monitor some pockets of vulnerability in the banking system related to exposures to large borrowers in some countries, and also unhedged FX exposures. Moving into fiscal, we see a need to a gradual fiscal consolidation in most countries in the region. Why is that? First, because in a context of very high uncertainty and downside risk, there is a need to rebuild policy buffers, particularly fiscal buffers, to make sure that in case some of these shocks materialize, countries can deploy countercyclical fiscal measures. There is also, in some countries, gross financing needs remain high, in the order of 12 to 15% of GDP. North Macedonia, Albania, Montenegro are examples. So here also, like a gradual consolidation is needed to ensure that in case some shock that may tighten financing conditions can be faced, in a solid way. And finally, there is a need to consolidate, taking into account some medium-term fiscal pressures that we are seeing coming for the region. And this is not something that is only, we are only seeing for the Western Balkans, but I would say more broadly for the whole CESI region, Central Eastern and Southeastern Europe. I'm talking about some pressures over the medium term to increase defense spending, but also public spending related to aging, right? Health spending, pension spending, as well as some climate-related spending. So, making sure that there is fiscal space created to accommodate this is important, to prevent, putting public debt in an increasing trend. And before I finish, I want to mention one, policy challenge that Richard mentioned. I fully agree that competitiveness pressures are becoming an issue. He mentioned, the unit labor costs that are increasing because, wages in real terms have been growing way above productivity in the region. Again, not only in the Western Balkans, but more broadly in the CESI region. And Richard mentioned that, if this continues, we may eventually see some, signs of competitiveness pressures. I think we are already seeing some. Industrial production has been relatively weak in the region. Export performance has been weak. And if you look at global export shares of Western Balkan countries, have been also declining in the last couple of years. So in a way, there are some signs that in some countries, this growth model based on FDI attracted by relatively low labor costs may reach its limits. So there seems to be a need in the region to move to another model based on productivity, skills, innovations, economic diversification.
Okay, thanks, and we'll come up onto that in the next round. So Marco, maybe from your side, we mentioned, and also Sebastian already mentioned now, about banks being quite as resilient and profitable and so on, which is actually true for the past few years. Can you give us your view on the banking sector for the Western Balkans? What are the current challenges that you might see coming in the near future?
Thank you, Milan. It's a great pleasure to be here. By the way, I'm coming from the region, and it's, believe it or not, my first visit to Kopaonik, and I'm properly impressed, and I'm looking forward to the next 3 days, where I'm sure I will learn a lot about the economies of the countries that basically we all try to follow and understand. As a former commercial banker, I think it's a good way to finish after the central bankers and the IFIs to make my few observations about what are the risks and opportunities for the commercial banks in the region, knowing that, of course, capital markets, not even in the Western Europe or Central Europe, are functioning. So banks will remain the main source of economic development for all the scenarios that have been described. So basically, we're both dependent on how the economies do and will also have a responsibility of providing proper financial services for the convergence that we're all hoping for. So basically, if I look at the region as a whole, the Western Balkans 6, we see that from a banker's point of view, non-performing loans are lower than they used to be, but still very high. So basically something that we need to bear in mind. Of course, we should point out that most of the banks, commercial banks in the region, are owned by foreign banks, which means that the transfer of know-how has been going on for decades now, because some of the banks from Western Europe have been here for almost 30 years by now, and therefore it's easier than the early transition period when basically we had to learn the ABC of commercial banking in other parts of the world and this region as well. So basically we need to be mindful of how the health of the balance sheets will be maintained and improved. Obviously, we need to, as banks, also see that geopolitical tensions, including what just is happening in the Middle East, will affect the environment in which we will be operating. So that's something that we have to live with. But as Milan said, every crisis is also an opportunity, so we can see this thing. We have to be mindful, and both the gentlemen from the World Bank and the IMF mentioned that some countries have a growing public debt, which is still low by Western European standards, but the dynamic or the direction is not required. Needless to say, also bankers are worried about demographics. I mean, this region has been losing people and aging even faster than some other parts of the world. So you will have fewer good clients, entrepreneurs, and everything that we have to be mindful about and see how this can be reversed. But for a bank, this is a risk or a challenge to make a 10, 5, 15-year program. The good thing is that we have a number of EU initiatives, and I'm not talking about the membership, which is, of course, is always a painful discussion, but the funds are available to actually provide structural changes to improve the governance in public sector and in the corporate sector. And of course, the same goes for the banks, where, of course, the parent banks should be able to translate some of the stuff that they have been practicing in their home markets. Convergence, it will be slow. As we said, I mean, 3-4% growth looks fine by Western European standards, but to catch up, we will need much more than that. So hopefully, someday, conditions will be to have a faster growth so that this gap will be closing faster and not in terms of generations. I think that since we are still at a relatively low level of development as banks, we can do some leapfrogging and go into digital faster than, say, Western European banks. That's something that is an opportunity. And again, there's a lot of know-how existing. It's not like we're just learning what digital banking means. We need to strengthen the corporate governance. I think the financial authorities in the countries should be mindful of that. And I hope that there will be more cooperation between the Western Balkan countries in this respect, also exchanging experiences, views, best practices, and translating them, and not just wait for Brussels or Frankfurt or Basel or whatever, how to do these things in a modern banking system. One example is SEPA, the Single European Payment Area, where a number of banks are already applying this. This will give a higher transparency, lower risks, but we still have to be mindful that even though we complain about corruption in Western Europe, this is a serious problem. I have to be perhaps a little bit less politically correct than some of the colleagues here on the podium, that unless we really tackle corruption, this will be bad news for banks as well. And we have to make our own contribution to say we will not tolerate murky practices. We will not lend to people who we don't trust or know well enough, both individuals and companies. So I would stop here and hope that we can have another round.
Absolutely, absolutely. Thanks a lot, Marco, for your insights as well. So maybe we can have a slightly deep dive towards some of the things that we already mentioned here. And Richard, you started saying about structural challenges and, in fact, also unemployment paradox that you mentioned, and we also have two more things maybe coming around us, and one is the initiative, the need for, or the push for friendshoring and nearshoring, which might be an opportunity for the Western Balkans in terms of the opportunities coming from the closeness, both geographical and political. And the second thing is, of course, is AI, which might really impact the structure of these economies. And we had past period where also Serbia contributed a lot in the IT sector, but it was more onto providing services which essentially can be now replaced pretty much a lot with AI. Now, having this in the background, what would be, from your point of view, industrial policies for the upcoming 5 years towards which we should focus on to gain the maximum out of the opportunities we have?
Thanks, Milan. So yeah, I think the theme of this year's Kapaunic is industrial policy. So I was kind of trying to read up a little bit this week. I found a really good quote, which I'm going to pass off as my own, but it's not. And it's, industrial policy is like cholesterol. All economies have it, but there's the good type and there's the bad type. And maybe the challenge is to know which is which I think is not easy at all. But I think clearly for the longest time, the sort of thinking on industrial policy was don't do it, it's too difficult, or maybe it's not easy for government to pick winners, but I think the expression was that losers are very good at picking governments and you can get stuck with kind of spending heavily on subsidies and not getting much for it. But there was always this acceptance that, well, in some places it has worked, even though everyone says it shouldn't. Some places, mostly in Asia, it has worked. And then I think, for all the things you mentioned, right? So the green transition, just when we were talking about sort of shift towards decarbonization, renewables, we see this surge in industrial policy spending in advanced economies among all of those who often said don't do it. And then you add in sort of AI, technology, add in sort of complex geopolitics and this sort of panic in Europe that we need to have sort of domestic and economic and industrial capacity, and sort of talking about decoupling from China, from the US, and so on. So all of that sort of coming together, and frankly, industrial policy is becoming the new normal everywhere. I think it'd be naive to suggest that any economy is not going to pursue it. So the question is maybe what are some of the lessons on maybe what is more likely to work and maybe what less to do. So we sort of three kind of factors, if you like, coming out of the emerging research that we've seen is firstly government bandwidth. So the ability for the government to undertake policies that engage with firms and are able to sort of provide targeted support and conditioning. So the challenge, of course, is I think probably governments everywhere tend to think they have more bandwidth than they don't. But anyway, the extent to which governments can engage at a technical level with particular industries, including space, especially technology sectors. Secondly, fiscal space, again, so the ability to have resources that can be deployed. And then thirdly, the size of the domestic market. That's probably less relevant in this part of the world, but those countries that have large domestic markets can use that as a powerful lever to condition industrial policy. So we're really left with how much bandwidth do you have and how much do you have to spend, and then how can you perhaps try to minimize wastage and ensure the highest quality of spending. I think what sort of universal thinking is that targeted public goods are kind of the lowest risk. That's things like industrial parks, having economic infrastructure, trade facilitation, border systems, payment systems. Marco just mentioned SEPA. Hopefully, I think Serbian banks will be going live on that. So the sorts of things that sort of help, at a general sense, reducing trading costs, reducing uncertainty. More challenging is when we get sort of beyond that, which is thinking about subsidies, about targeted policies, about incentives. It's not easy, clearly. I think there's some evidence that I think in this part of the world we've seen some encouraging evidence, I think with the Innovation Fund and the Science Fund, maybe a couple of examples. But maybe the one, I think, universal lesson I sort of found reading up is the importance of sunset clauses. So whatever you do it for a finite amount of time, and so that it phases out, and have a rigorous evaluation process so that every time a subsidy or something is deployed, remember what was the promise at the beginning, and then when that evaluation period and sunset period is gone, say, well, did it deliver what it was expected to, and then try and make course corrections from that. And so perhaps a sort of iterative process. Final thought, if industrial policy is about trying to stimulate or direct productive economic activity, there's actually one policy which has probably been the world's most successful industrial policy for small emerging economies in this part of the world, and that's joining the European Union. So if you're going to deploy scarce sort of brain power, effort, policy effort, maybe that's, over the sort of medium term, the area that's likely to get the highest return. We know the window is open after not being open for a long time. I think certainly it looks like Montenegro, Albania are going to jump very quickly into that. I think it will remain open for some time, but my sense is once Ukraine comes in, the appetite for Europe to absorb more members is going to be more limited. But I think there's a whole other panel on that. Thanks.
Thanks a lot, Richard. Dimitri, you also mentioned about a bit of the changes in export composition for both Western Balkans and also coming into the Western Balkans or the composition of their imports. So how is that important for industrial policy? Can industrial policies play a role in those sectors if we want to maximize the potential that we see at the moment and in the near future?
Yes, definitely. I mean, for increasing the potential growth, reforms are in the first place, but industrial policies are also quite helpful. And actually, in our transition report 24-25, we made a deep dive into global industrial policies and tried to draw some conclusions from there, what works, what doesn't. So when we talk about key enablers of industrial policies, the selection is quite intuitive. It's important to have clear, prioritized objectives. Successful policies that articulate one dominant goal, either it is growth or green transition or maybe regional development. Many failures that we saw stem from multiple conflicting objectives without clear hierarchy between the goals they want to achieve. Then also it is quite necessary to have strong state and administrative capacity. So effective policy requires quite capable public administration, ability to collect and analyze data, to undertake technical evaluations, to monitor implementation. Country need to have adequate fiscal space, and Richard mentioned it, so I will not repeat it. Allocation mechanism should be competitive and transparent, and this is very important. There should be instruments that introduce competition, open calls, export orientation, private sector co-financing. All these instruments could reduce political capture and improve effectiveness of industrial policies. And sunset clause, we also found that sunset clause is very important to be in place. Human capital, digital infrastructure, institutional quality, they're all particularly vital for service-led growth and innovation-intensive sectors. High-skilled workforces enable ICT sector, R&D, professional services specialization. So countries that do good in these areas, they can attract such investments in the economy. And the last enabler I would mention, there should be public-private coordination. Structures such as investment councils or sector working groups, they help identify bottlenecks and coordinate between the actors that are in the industrial policy. When we talk about likely winners of industrial policies, there are certainly economies with strong fundamentals, countries with high administrative capacity, with strong governance, skilled labor, quality infrastructure, and they're best positioned to benefit. And we found many examples in our region, like Estonia, Lithuania, Czechia, Slovenia, which are quite successful in this. Then from sectoral point of view, the winners are high-skill, innovation-intensive service sectors like ICT, professional services, financial services, R&D-linked activities, because they have the strongest productivity growth and potential for export expansion. And fortunately, also Serbia is among these countries as a country which is relatively small, but become quite important global exporter of ICT services. From the point of view, from the firm point of view, the winners are usually young, dynamic firms with scaling potential. And we found out that usually firms with who exist less than 5 years generate high employment growth and returns on capital. They use quite well targeted state support like grants, advisory services, startup programs. But also large globally exposed superstar firms are also a winner, because when they're well regulated, such firms drive exports, drive productivity, innovation. However, here we need to be quite cautious because there's a danger of growing to excessive dominance and capture of these firms. So therefore, it is needed to have strong competitive safeguards in terms of good regulatory agencies in the country. Special economic zones, a lot has been thought about it. They succeed when they combine skilled labor pools, high quality local governance, proximity to ports and transport corridors, clear regulatory framework. So all this helps to functioning of the special economic zones. And which sectors have the strongest spillover and supply chain linkages? There are certainly automotive, green technologies, advanced manufacturing, ICT, hardware, software ecosystems. So these are mostly our main findings, which are for industrial policy. And we see actually that Serbia is implementing a lot of it.
Thanks a lot, Dimitri. Maybe one thing you also mentioned, but also for Sebastian and for Richard. Richard, you mentioned about the potential for that EU accession can help in industrial policies. And Dimitri, you also mentioned the fact that strong governments and administratives are quite almost a necessary ingredient for successful industrial policies. However, if from the government point of view, they're typically short-sighted, right? Because you only think about your term. You don't really care about what's going to happen in 10 years from now, if this is going to be beneficial for your country or not. So, Sebastian, for you, the question is, this path to EU, can it be used as a catalyst to kind of support these two things, so to ensure that the governments are not really super short-sighted about the policy term, and that in that way to ensure that the benefits are there?
Yeah, the short answer is hopefully yes, right? So I agree with Richard's point that that the EU accession process provides a great opportunity for the region. Although, I mean, I think it's also important to say that the gains that are expected cannot be taken for granted, right? So in fact, there is an upcoming IMF paper on this issue that will be released during the spring meetings next month. Precisely focuses on what policies can be implemented to maximize the gains from EU accession, but also mitigate, reduce the potential risks associated with it. For example, given that barriers to emigrate are lower, they potentially increased emigration, but also potential overheating in the short term due to rapid access to large amount of foreign capital. So this is something that is tackled in this upcoming report. I want to highlight a couple of things. The study will be looking at the different channels through which these gains can materialize: labor, capital, and productivity, and it will be both looking into previous accession cases and also model-based simulations. And in the case of, our estimates point to substantial gains in the case of previous, new member states, right? I mean, the order of, on average, 30% increase in GDP per capita, 15 years after accession. And this is mostly coming from capital accumulation and increased TFP. And these gains do not come only from getting access to the single market and access to easier and cheaper access to foreign capital, but also, and more importantly, I would say, from all the reforms that are implemented in the process. So that goes into the direction that you mentioned, and the model-based simulations also support this view. We, in particular, when you look at gains from productivity, not only affect directly but also indirectly the per capita GDP gains through increased capital accumulation as well. So that's where, in our view, policy should be focusing, to maximize the gains. And here I will mention one area in which potential gains are the largest for the Western Balkan regions, which is governance. Here Marco mentioned one particular area, corruption. We agree with that view. It's still perceived as high across the region. Rule of law, contract enforceability, the efficiency of judicial systems. All of these are important elements that, of course, affect the business and investment climate, and potential gains from reducing these gaps are sizable. I mean, another recent paper released by the IMF on this topic points to potential gains of roughly 10% over the medium term, over 5 years, by reducing by 1/2 gaps vis-a-vis the best standards in Europe. So this is an important area in our view. And very quickly on just to touch upon the topic of this conference, right, industrial policy. So I mean, in general, the fund's view on industrial policies in Europe are very much aligned with what Richard summarized. We think that in some particular cases can be helpful, but those in general need to be well-targeted measures and policies, and also policies that try to address some specific market failures. So certainly we also agree with some of the don't do, which is the picking winners based on lobbying and political pressure or influence.
But that's the easiest one.
Yeah. But also some measures that we've seen in many countries that have implemented these policies is to support low productivity or declining sectors. Also measures that that protect local firms from trade, or even state-owned enterprises from market competition. All of these measures, avoiding these ingredients in these industrial policies is important, because otherwise there could be an increased resource misallocation and also higher fiscal costs of industrial policies, right? And the final point on this would be that in any case, good industrial policies should not be a substitute for horizontal structural reforms.
Absolutely. Marco, Dimitar also mentioned Slovenia as one of the good examples of the progress that was achieved over the past 20 years. Maybe we can share more insights, what you see as what we can learn from Slovenia and potentially Hungarian experience.
Thank you. But first I have to say that what I hear from colleagues from the IMF and the World Bank, if somebody had told me 20 years ago that they will be advocating industrial policies, I would say, wow, we've come a long way. Anyway, I think that the Washington consensus is dead, and the fear of industrial policies is also dead. But I like what Richard said, that probably for the aspiring member states, joining the EU is perhaps the most rational set of industrial policies, because it's a little bit like you were saying, the cholesterol, good or bad. And I think that the EU industrial policies are perhaps less bad than some others. So basically, having said that, and since you asked me about the experience in the neighborhood of countries which have joined the EU 20 plus years ago, and I'm talking about Slovenia, my home country, and Hungary, which I also follow a little bit, and they are all in the neighborhood and very much present in the region. I would say that essentially, while we are very critical in Central Europe, particularly my Hungarian friends, but also my Slovenian compatriots, of how things have gone in our respective countries and how much better we could have done, all of which is true, it's still something which basically could be a very nice example for the Western Balkan countries, despite their frustrations and hot and cold type of thing with European capitals and Brussels. So essentially, our access to capital now is infinitely easier in Slovenia, including Hungary, than what we see here, which in itself is a big advantage. Okay. Secondly, the pressure to streamline and increase the corporate governance and fight corruption And again, people would jump on me and say, don't talk, there's no corruption in Hungary or Slovenia. Of course there is. But it's all relative, and the pressure is such that perhaps there are some limits as to how far you can go in corruptions, and I don't want to go beyond that. Essentially, the ease of doing business, following some European EU rules, makes it easier for somebody who wants to invest in Slovenia, in Hungary as well. Let's not forget it has a large investment in energy and the automotive sector, including BYD will be made in Hungary as of next year. So, they are doing something right, if you wish, if you want. But essentially, from an FDI perspective, being part of the EU makes it easier than if you're somehow in murky waters and don't know which way the things will go. And then, of course, the financing of the investment gap, which is significant, which slows down the development in this region, despite its potential, can much more easily be closed if you are part of a wider market. Now, let me give at the end 2 examples of 2 banking groups from the 2 countries. One is called OTP, Hungarian bank, and the other one is called NLB, my former bank, by the way. I see that they are now advertising here. I have nothing to do with that. I'm Anderson, by the way, nowadays.
And OTP is also there.
So if you look at banking, commercial banking 30 years ago, here in Hungary and in Slovenia, it was dominated by Western banks. We thought that the Austrians, the Germans, the Dutch, the French, the Italians will dominate the banking scene, which was the case for a while. And then due to various circumstances that stem from the capitals and the headquarters of the Western banks, there has been a clear, shall we say, pulling out or lowering down the presence in these countries of Western Balkans, whereas OTP and NLB have become major players. So that goes to show that basically if you look at integration, it should be viewed not how do we attract a Spanish or a Scandinavian bank to this part, but look at the neighborhood. And we are a great example. OTP makes 60% of its group profit outside Hungary. And therefore they're much less vulnerable to the ups and downs of the Hungarian economy and politics, I should say. Ditto for NLB. NLB has always been present because of the former common country, but they are now basically in every market of Western Balkans, save for Albania. And essentially, that goes to show that if you want to have good integration, let's look in the radius of 500, 1,000 kilometers and not dream, and we can learn from each other and benefit. And it's a mutual benefit. I think that both OTP and NLB are appreciated and successful here, at the same time benefiting the trade flows, investment flows between the region, Western Balkans, and those countries in the neighborhood. So I think that there are some success stories that we should be basically looking forward to and do more of them in the energy sector, in other sectors where basically potential is there. Our knowledge, Hungarian or Slovenian, about the Western Balkans is much higher in our understanding than it is if you come from a faraway place in Western Europe.
Thanks a lot, Marco. We are on schedule, so maybe I can just pause here and then open the floor for any questions. If there are not, then we have another thing, a couple of topics that I would like to discuss with the guys. But let me pause, and if there are any questions from the audience, let's take them now so that we ensure that the audience had the opportunity to ask. Okay, if not, maybe we can inspire you. Oh, Nicola, yeah, please. I could have asked a question in the meantime.
Thank you very much. Nicola Piparmato, Serbian Fiscal Council. I wanted to ask a couple of questions, mostly pertaining to the medium term, because we are actually, most of the topics that were covered were effectively short term, and we are actually very much concerned how Serbia outlook is going to look beyond 2028. Of course, everything is going to be dominated by Expo until 27, but what happens after 28? In particular, I think the Serbian Fiscal Council and IMF had a a joint understanding that potential GDP of Serbia is around 4%, or at least was 4%, but we are now concerned that Serbia can no longer achieve 4% due to lack of reforms, due to lack of TFP growth, due to lack of productivity. So what is your outlook? What is the potential GDP growth for Serbia going forward? I have to say that we are not so optimistic that FDI is so relevant and has so much power in improving productivity, because if you look at the FDI composition, 70% of FDI went to traditional sectors, from real estate to mining. Only 30% was high-tech IT, and even that 30% failed to expand into broader manufacturing and industry. We believe, but Professor Petrovic might say a bit more in the next panel, but we believe that's a crucial problem with the lack of rule of law and lack of governance and institutional framework. And lastly, speaking of institutional framework, and I mean, both Richard and Dimitar and Sebastian mentioned the importance of government's capacities and qualities. Unfortunately, we have seen a big deterioration of government capacities over the previous decade, and we don't believe it was due to lack of reform. We believe it was due to bad reform, namely the bad salary scale reform in Serbia that introduced unprecedented wage compression that used to be 1 to 9, now it's less to 1 to 5 when you go to maximum to minimum wage. And that's why the government in Serbia is no longer able, according to the law, to basically attract qualified people, and which is diminishing technical capacities of the government. And we were actually kind of shocked when we heard that the World Bank is now urging us to go back to this 2016 law, which we think was a root of many problems and not solutions. Thank you.
The question is, Nicola, the question is for Richard, I guess, or Sebastian, or whoever wants. So, yeah.
I can start quickly, Nicola. Thank you for the question. Yeah. So overall, I mean, we are seeing. I mean, I did mention that in our view, the potential growth in not just in Serbia, in the region, across the region, is limited by significant structural gaps, particularly in the area of governance, right? And we have actually reduced moderately estimates of potential growth across the region. I mean, for example, in Albania, in North Macedonia, and so on. I'll let my colleague Lev speak more about Serbia in the next panel, because we have a dedicated full panel on Serbia coming. But overall, I think the message is the same. I mean, there is a need, as I mentioned before, to move to a productivity-led model based on other factors: innovation, strong institutions, skills, and a better diversified economies, right? I mean, Richard mentioned at the beginning that, growth was particularly strong in countries in the region that rely on tourism, for example, Albania and so on. But that model eventually will also reach a limit, and there is a need also in the tourism-related economies to diversify, in terms of sectors as well, and also taking into account the competitiveness pressure related to higher unit labor costs. The only way out is reforms to boost productivity. And whether, I mean, you mentioned the lack of progress in governance area across the region. This study that I mentioned that points to significant gaps, particularly in the area of governance. I mean, we look at all potential structural gaps: labor market, governance, and the area in which the Western Balkans is lagging behind the most is in governance issue. And here I would link it to a topic that I mentioned before with the EU accession process, which I think provides the opportunity actually to by aligning with EU standards, to strengthen policy frameworks in this front and reduce the gaps. Yeah, let me stop here.
Okay, thanks. Yeah, no, I mean, on FDI, I think I agree, right? And we know Serbia's been very successful at getting a high volume of FDI, but the bulk of it has been in low-end production. I think that actually links back with industrial policy, right? About having a more targeted set of policies that address certain typologies of FDI that bring things that Serbia need. I mean, we no longer need creation of low value-added manufacturing jobs. It's about different types of things that come with FDI. But the reason I made that point is when you look at the micro data for where is productivity growth coming, when you build up from enterprise level data in Serbia, you see on average, not going very far anywhere very quickly, but where you see positive improvement is in new entrants. And we know domestic investment has been fairly sluggish for some time. So there is obviously within that FDI space, there are some elements which are clearly contributing to FDI, to productivity growth. The challenge, and that comes back to industrial policy, is how do you get the good stuff and maybe worry less about the bad stuff, or at least don't incentivize the stuff at the other end of the scale. Maybe on, pensions, we have, I think, one of the region's foremost experts, Sasha, in the next panel, so maybe you can talk to him about that. But I think this is where, going back to industrial policy, two of those kind of prerequisites can often come in confliction, right? So how do you have a capable government which is able to manage complex industrial policy, but also having fiscal space? I think one of the reasons why Serbia is actually quite well placed in terms of current fiscal policy is because we didn't see the public sector wage bill increase as much as, frankly, everywhere else in the region in the last few years. But so it's a balance between the two, right? Being able to attract and motivate and retain high quality, high skilled individuals, while also having a fairness across the system, which balances fiscal needs and cohesion across different types of jobs. But I think Sasha would be much more eloquent on that. Finally, in terms of potential growth, you could imagine, yes, you're right, demographics are not good. Productivity is not good. Short term, we worry about investment. But then it's not hard to imagine, say, in 10 years' time, Serbia, or frankly the whole region, being the next Poland or the Slovakia of the 1990s, part of the European Union, where we see a sort of shifting production, highly integrated production networks, and significant kind of economic activity shifting once borders have been reduced. Frankly, there's a long way to go in terms of per capita incomes and wage comparative advantage if you compare the Western Balkans now with jobs that are being done in Poland, Czech, Slovakia, etc. Thanks.
Thanks, Richard. Maybe one more short question, and then I can also have one short question for all of you guys. Jelisaveta?
Hvala. Thanks, Jelisaveta, FAFA faculty. In this state of uncertainty, Serbia is still emerging economy and competing with the rest of the world, for example, from South Africa or emerging Asia, who are generating, higher yields or higher return on investments in the same, I would say, in the same level of uncertainty. So I'm wondering, how do you see are we in a kind of emerging economy trap, and how are we going to generate, yields and return on investments in a real economy in the period to come? How we can compete with the rest of emerging economies in the world?
Thanks. Marco, do you want to take for the beginning?
As an outsider, and of course I don't know all the accumulated knowledge about this with the IMF and the World Bank and the EBRD, of course, I would just say that, if we are now embracing industrial policies, which I agree with, even the West, we should also learn from the emerging Asia, where they have a multi-year plan which goes beyond a term of one government. Now, of course, in parliamentary democracies, no matter how many faults they have, it's very difficult to convince the policymakers to say, don't focus on 27, 28. There was a question there. Why don't we all have a plan as a society? And it sounds very naive, but without this, we will not succeed. Where do we as Serbia want to be in 2035 or beyond? And then have some basic points that we can all agree on, particularly, when parties change in power. Of course, that doesn't happen too often in some parts of our region, but at least they should have something which you say, regardless of whether I'm left of center or right of center, let's have a few points where we say, we all agree what do we need to do to become a more developed economy, not to fall in the emerging economy fault. And there's more and more discussion about this also in some parts. So if we can promote this more, so that people, even when they draft their election programs, they take this into account, that could be one contribution to say, okay, we may follow the good examples of Asia. Very naive. And I'm easy because I don't represent this.
Thanks a lot, Marco. Maybe just for we have less than 1 minute, very, very quickly, just in 10 seconds for each of you guys. So how certain is uncertainty for 2026? What do you say? So will it be higher or lower compared to what we expect now? Sebastian?
Yeah, I think it will be at least as high as it is today. So the main policy advice for policymakers in the region is to, rebuild buffers and strengthen policy frameworks and credibility to improve resilience to potential adverse shocks.
Thanks. Dimitar?
Yeah, it seems that uncertainty remains structurally elevated, driven by geopolitical conflicts, trade policy volatility, and what is important, uncertainty has some cost. Investments are delayed, FDIs are weaker, macroeconomic planning becomes tougher and more costly. Fiscal and monetary authorities face wider forecast bands, tighter risk controls, and a need for larger precautionary buffers. So in a sense, uncertainty behaves like a tax on growth. It reduces capital formation, increases the cost of capital, erodes confidence. And yeah, we are unfortunately in such a period where this will remain for the time being, and we need to get used to work in such environment. And having the global uncertainty, we should not at least add our domestic uncertainty.
That's a good point. Thanks a lot. Richard and Marco, very quickly, and then we finish.
Yeah, so very quickly, I think, yes, agree with Sebastian, buffers. And then two, maybe this links to successful emerging market economies in East Asia that Marco mentioned, is what we often see is when external uncertainty is very high, and East Asia is being buffeted by tariffs right now, is do everything you can, or with everything that policymakers can do to reduce and limit domestic uncertainty, or at least those sources which are within the control of policymakers.
I think the risks will increase given the geopolitics of the recent weeks and days. I think that here EU has a responsibility to say Western Balkan risks are also our risks. And I very much welcome, I'm sure most of you saw the letter that Edi Rama and Alexander Vucic wrote in a German newspaper, I think it was Frankfurter Allgemeine a few days ago. I would want to see more of these signed by more political leaders in the region.
Thanks a lot, Marco. And from my end, very warm welcome and to guys to Koponik one more time. And thanks a lot for coming to this panel and have a very successful and joyful stay at Koponik. Thank you.